Over the last few days, we've seen a lot of disruptions in the markets. We had that Fitch downgrade, yields rising, VIX even moving a bit higher. Seen some mixed results when it comes to what we're seeing from the different indexes. What are you expecting today?
Today we've got a number of cross currents. Again, we've got this data coming out of China, which is disappointing on both imports and exports. This is setting the tone for global markets this morning. The cardboard box recession continues. This is where anything you can put in a box, either manufacturing or shipping, is in a recession right now. And that's really weighing on the global economy. Services are still doing okay, but in the last couple of months, we've seen the PMI for services weaken. The Purchasing Managers Index survey of services firms starting to soften up. So maybe the recession's coming out of the box, spreading into services. We'll learn a little bit more about that today from some of the companies reporting earnings.
Yeah, you're kind of leading us into the fact that UPS is reporting before the bell this morning. So you're mentioning that we're seeing a slowdown in shipping. So is UPS a potential market mover? Obviously, it gives us a lot of insight into the state of the consumer, at least what they're buying online.
Yeah, to the extent that their guidance, I think, will give us a sense of what's going on right now. Is there more demand for things going in or moving around in cardboard boxes? We've seen actual cardboard box demand falling on a year-over-year basis. It's down over 10%. That only happens during global recessions, at least as we look back over the last 25 years or so. So that'll be a good indication. Are we seeing better demand for UPS's services? A good indication of whether the weakest part of the economy is beginning to show signs of strengthening.
All right, we're also going to get a sense of the confidence when it comes to equities. We see bond auctions starting today. The 3-year begins today. Looking at the yield on that 3-year, 4.4%. How do you see that impacting the equity markets today with such attractive yields coming on the market?
Yeah, that's the key. We've been emphasizing factors over like styles or cap sizes when it comes to investing. We've been really focused on price to cash flow, really focusing on shorter duration stocks. Those stocks expected to deliver a higher proportion of their cash flows in the near term rather than the more distant future. So we use price to cash flow to measure this. And the lower price to cash flow stocks have been outperforming since rates began to rise back in August of 2020. They stumbled a little bit during the banking turmoil earlier this year, but they're back on top again in June and July. We're seeing consistent outperformance there as companies able to fund their own borrowing basically out of their own cash flow are doing a lot better than businesses that have to borrow at those 3-year rates. So I think they'll continue to outperform, and they're showing some signs of maybe a little bit more resilience today, even on the downside.
Yeah, I want to circle back. We were talking a little bit. You're leading us into earnings a bit, talking about the cardboard box recession that led us to UPS. A bunch of other earnings this week as we wind down earnings season. With that in mind, what is your WEX word of the day?
My word of the day is layoffs.
Really?
Disney reports today amid rising scrutiny caused by labor disputes and the potential for more layoff announcements. It's layoffs that have stood out to me this earnings season. On Friday, Canada's unemployment rate rose for the 3rd month in a row in July, joining other G7 economies like the UK and Germany in marking a turning point in the strength of the labor market. And there may be more coming, Frank, because commentary from business leaders on earnings calls so far this reporting season reflects more layoff discussions outnumbering those that talk about labor shortages, which of course dominated calls all last year. And we're seeing it from a range of industries. We heard it from CVS, from InBev, from Biogen, from Qualcomm, T. Rowe Price, a money manager. So it's not just concentrated in tech. We could finally be seeing a turn in the global labor market.
So a quick follow here for you, Jeff. Does that give stocks a boost? Because there was a while there, at least last year, when we saw those tech layoffs, company announced layoffs, stocks shot up because they were essentially cutting cost.
Yeah, this will certainly be focused on cost cutting, but there is some concern, and we'll get the consumer sentiment numbers on Friday here in the U.S. Will that begin to feed into the pace of consumer spending that's helped to sustain the economy? We'll have to see.
All right, something we'll have to watch. I want to bounce some of the headlines that we're getting this morning off of you. First, banking sector risk. Moody's downgrade. Now Europe cracking down on profits. How do you see that impacting the broader financial sector?
Yeah, this is something that banks, particularly in Europe, have had to focus on. It's not just Italy that's been cracking down. UK banks have been bandying about the idea of a windfall tax. We know there's some Baltic countries, Lithuania, Estonia, a few others that are putting in windfall taxes. This is a cloud that may hang over some of the banking stocks in Europe for a while. In the U.S., certainly there are issues with commercial real estate, not so much in Europe, but definitely here in the U.S. with vacancy rates in office property over 25% in major cities like Atlanta and Dallas and San Francisco. That's going to be something that's going to linger over the financial sector as well.
Also have to ask you about China. A lot of concerns about demand in China. We see another batch of weak economic data overnight. We have a lot of U.S. companies that are fairly heavily levered to China as well. How big of a risk is that to the U.S. markets, the weakness we're seeing in China?
It is. It's the second largest economy in the world and a big consumer market for U.S. products. But I'd note one of the things I've been watching is air pollution in China, measured by the U.S. consulates there using EPA tests. It's bottomed and started to pick back up again. That's not a normal seasonal trend. That tells me there's more, because there's more air pollution, more manufacturing, more activity, more driving around. That's usually a sign of economic momentum in China. It bottomed at the end of the second quarter, started to pick back up again. If that continues, could be brighter news for China on the come.
So, Jeff, very quickly, looking at the futures right now, the Dow pretty close to its lows of the morning. The S&P and the NASDAQ also moving lower throughout the morning. What are you expecting from today? Another down day, or do we see kind of a rebound?
Well, I think we could consolidate a bit today. Again, we've got those important earnings after the bell, and we're still focused here on what we're going to hear from those Fed speakers. That's still very important this week, given that we're not quite sure whether the Fed is actually finished or not.